You're paying 3.5% more for everything you buy now compared to last year, because U.S. inflation fell to 3.5% year over year in June 2026. This is the first decline in 5 months, but still above the Fed's 2% target. Right now, this number matters because it affects how much you can buy with your money, and it's a key factor in the Fed's decisions on interest rates. This month, the inflation drop is getting a lot of attention, but what does it really mean for your wallet? To understand this, let's look at how inflation works. In simple terms, inflation is when the things you buy, like food, housing, and clothes, cost more over time. It's like if your favorite coffee used to cost $2, but now it costs $2.07. That's a small increase, but it adds up. The Fed aims to keep inflation at 2% because that's a sign of a healthy economy. But when inflation is too high, like it has been for the past year, it can erode the purchasing power of your money. Now, with the inflation rate dropping to 3.5%, some people might think it's time to breathe a sigh of relief. However, this drop is still a long way from the Fed's target, and it's not clear if this trend will continue. One clear idea to take away from this is that even small changes in inflation can have a big impact on your budget over time. For example, if you have $1,000 in savings, a 3.5% inflation rate means that in 1 year, your money will be worth about $965 in today's dollars. That's a loss of $35 just from inflation. So what can you do about it? The key is to be aware of how inflation affects your money and to make adjustments accordingly. This might mean looking for higher yield savings accounts, being mindful of price increases when you shop, and considering investments that historically perform well during periods of inflation. Right now, it's more important than ever to stay on top of your finances and to have a plan in place for dealing with inflation. The takeaway here is that even when inflation drops, it's still crucial to be proactive about protecting your purchasing power and making your money work harder for you.